One question that we get asked frequently by all kinds of investors is how much of their money should be invested in stocks. We like the idea of higher expected returns, but we know that the risk associated with stocks is just higher. Market volatility has been in the news a lot the last couple of years, prices going up and down quickly, and not just for stocks, but bonds as well. And while we're not at March 2020 levels of volatility, as seen here in this measure of the VIX, which is just a measure of stock market volatility in the US, things are still elevated relative to the last decade. So the question about how much of our portfolio to have in stocks can be a complicated one to answer because there's more than one reasonable answer for every investor, and each investor has their own unique circumstances and preferences. For most people, though, the answer is something less than 100% of their investable assets. A quick look at stock markets so far this year gives an indication of why not 100%. If you had a planned expense at the end of last week, and you had invested the money set aside for this expense in stocks on January 2nd, for every $10,000 you set aside, you might only have between $8,000 and $9,000 left, given the performance of U.S. and foreign stocks so far in 2022. Most of us know that for an expense in the next 6 to 9 months, stocks may not be the best answer as a short-term savings vehicle. The reason stocks could go up in value, sure, they could go all up a lot, but they could also go down a lot. And this year, due to rising inflation and interest rates, even bonds have been down over 10% at times. So stocks and even bonds may not always work as short-term savings vehicles. This line of thinking can help us answer the question, how much should not be in stocks? Rather than starting with the question of how much should we have invested in stocks, it's often easier to figure out how much should be in things other than stocks, including cash, short-term bonds, and intermediate bonds. So how can you go about answering the question, how much not to have in stocks? Well, one way is to look at how long stocks can be off their high point. The basic rule of success in investing is to buy low and sell high. This chart shows 3 asset classes and maps the times where they have been off their most recent high, how long they've been off that high, and how far off they were. It's often called a measure of drawdown. Pretty easy to see that stocks, the purple line, can be off their highs for years at a time and by a very large amount. Bonds in orange have been far less volatile than stocks, and short-term government bonds even less so, pretty much holding their value. Let's assume that you invested $10,000 in each of these assets on January 1st of this year. Again, looking at 2022 year to date, if you needed the $10,000 last Friday, only the Schwab money market held its value at or above your invested amount. The short-term bond fund was close, down only $425, but rising interest rates had impacted it as well, at least in the first 7 or 8 months of the year. Stocks and bonds were down close to $1,000, though global stocks had been down over $2,000 at times in June. Not a lot of good news for your savings outside of that cash or money market. Now let's look back at the last time we saw a 2-year or longer drawdown in global stocks. We'll start in January of 2008. Early days of the great financial crisis and housing crash. At the end of 2 years, December of 2009, if you needed your $10,000, the Schwab money market had held its value. Vanguard short-term bonds were worth $1,000 more than you started, and the aggregate bond index was worth almost $1,150 more. The global stock market, however, was down over $2,100. You likely had less than $8,000 of your original 10. But fast forward now to 10 years later, the end of 2017, the money market was basically flat, never in drawdown, which makes sense in what was a time of very low interest rates. The Vanguard short-term bond ETF had appreciated by $2,600. The broader bond market had appreciated by over $4,800. But look at that global stock market. It had not only fully recovered from a historic loss, but it also may have grown your $10,000 to over $16,000. Short-term bonds in the bond market were in positive territory by the end of 2008 and well above $10,000 by the end of 2010, more than 1 year later, but less than 3 years later. Short-term bonds recovered and stayed positive in a shorter time than the broad bond market, but stocks crossed back into positive territory finally in early of 2013. They had a bit of a retreat in late 2015, but by mid-year 2016, 9 and 10 years out, they had produced the strongest overall return. So, how does this help to answer our question, how much should not be in stocks? Here's what we have found to be a very helpful way to think about this. I need you to hang in there for a few minutes because we're going to do a little bit of math. We're going to use a very simplified version of what insurance companies and pensions call asset liability matching. The idea here is to match an asset with a cash flow, a liability, something that you need money for, in a way that the asset is not underwater in drawdown and has a chance to be well above water when it's finally sold to fund that withdrawal to meet the expense that you've planned on. How much money will you need from your portfolio, including bank accounts, in the next 18 months? Well, you may want to allocate that dollar amount to cash, like a money market. How much money will you need for your portfolio starting 18 months from today and extending to 36 months from today? Okay, let's allocate that dollar amount maybe to short-term bonds. Finally, how much money will you need for your portfolio from the end of 3 years from now, so 36 months from now, through 8 years from now? Allocate that dollar amount to a broad bond market portfolio. Now, after calculating the dollars that probably should not be in stocks, because remember, we want to avoid having to sell a stock in drawdown to fund an expense, we subtract that number that should not be in stocks. And remember, we're subtracting it from the total amount that you have available to invest. This would include your 401k, your IRAs, after-tax investments, and bank accounts. These are all part of your total portfolio. That difference between the total available and the amounts you just calculated as dollars not to be in stocks, that represents the amount that could be in stocks. Now, depending on your financial plan and what kind of total return your portfolio must generate over the rest of your life to meet your goals, some or all of these dollars may need to go into the higher expected returning global stock portfolio. Now, could be is the key word here. Could be in global stocks is really an important caveat. Investors need a financial plan that helps them understand just how much return they need to meet their goals at a minimum. They also need to understand just how much price volatility in their investments they can stand. There's a balance there. If the goals are too aggressive, investors can end up in portfolios that create too much anxiety. And anxiety is not only uncomfortable, it can lead to bad decisions like selling when things are very low. Oftentimes, an investor working with an advisor is figuring out the balance between pursuing higher long-term expected returns, their goals and the timing of those goals, and something you could call the sleep factor. As always, our advice to investors is to construct a portfolio based on a well-thought-out financial plan that balances priorities, including having timely access to cash when needed. Long-term inflation-beating growth, usually provided by a globally diversified stock portfolio, and then managing overall volatility, often with bonds, are the parts or portions that we allocate assets to. Risk and return are related. So in answering the question, how much in stocks, something to remember is that with the long-term higher expected returns of those stocks comes higher risk and volatility. A portfolio you can live with should balance the question, how much do I need in stocks, really with how much should not be in stocks. You know, we love to answer questions from the people who are watching these things. This was actually a question submitted by a number of people who we've talked with. So if you have questions that you'd like to see us address in the future, please submit them and we'd be happy to address them. Otherwise, we hope to see you in 2 weeks, and thanks for watching.